Welcome to PhillipCapital's Weekly Market Watch. My name is Yi-Ling and I am an investment analyst at Phillip Futures. Today I would like to share with you what are some of the key factors affecting gold prices in 2011. Let us recap first how gold has performed last year. Gold delivered a commendable performance with prices rising for the 10th consecutive year. Will it continue to rally in 2011? We think that the long-term uptrend for gold remains intact and gold may reach $1,600 an ounce in 2011. There are three reasons why gold could be attractive to investors. Firstly, gold may be attractive due to its safe haven status. Tensions in the Middle East may escalate further as protesters call for political change. Libya is currently the spotlight. We could possibly witness further violence in the days ahead if uprisings continue. Fears are now growing that the revolts could spread to other countries in the region, an event that will lead to greater flight to safety, boosting gold prices. Moving to my second reason, gold may be attractive as it is traditionally regarded as a store of value. Investors are increasingly concerned about inflation. Inflation in the UK has surged to 4%. This is a 2-year high and twice the target of the Bank of England. Investors fear that the US may follow in the footsteps of the UK eventually. After all, quantitative easing by the Federal Reserve has flooded the market with dollars. We expect US monetary policy to remain loose for an extended period of time due to the weak labour and housing market. This could allow inflation to creep up, increasing demand for gold as a hedge against inflation. Finally, gold may still be attractive to consumers and investors in China. The Chinese have a strong cultural affinity for gold. With rapid economic growth and rising incomes, Chinese consumers will purchase more gold. China has also announced plans to further develop the gold market. The Shanghai Gold Exchange is studying new products such as options and exchange-traded certificates. With greater liberalization, there will be more channels to trade gold and greater interest in bullion. Chinese demand for gold may rise to around 600 tons in 2011, driven by both investment and retail demand. Although there are many reasons for gold to head higher, investors should watch out for some downside risks. With economies recovering, central banks will raise interest rates eventually or lose their credibility in fighting inflation. A real interest rate hike increases the opportunity cost of holding gold, making gold less attractive. Already, holdings of gold at the SPDR Gold Trust have dipped to a 9-month low and investment interest remains soft. Empirically, we note the rising popularity of gold. There is a saying that when pop culture starts paying attention, a boom is starting to turn into a bubble. Gold ATM machines can now be found in upscale malls in Florida, dispensing gold bars of varying weight and style. Still, it may be premature to call an end to gold's rally. Gold bulls argue that gold is not in a bubble and that the current gold prices are still way below the highs of the 1980s on an inflation-adjusted basis. To conclude, we believe the rally in gold could continue. 2011 may well be the 11th year of gold's bull run. Gold still remains attractive as a store of value and safe haven. Should the political instability in the Middle East and North Africa escalate, gold prices could be further boosted by a flight to safety. However, as the rally in gold continues, investors will be tempted to take profits. A cautious investor may wish to weigh the upside potential against the downside risks before investing. That's all we have for you today. Tune in next week for more market updates.